Okay, so hi. Thank you all for coming. Thanks for joining us this morning in Florida. We're happy to be here. As it was just referenced, we're going to be discussing the new world of investing. And we're super excited to spend this time with you this morning. We know you had choices on where to be, so thank you for joining us. We're excited about this topic. I think the industry has spent a lot of time, rightfully so, talking about plan design, talking about autos, auto-enroll, auto-escalate, and leakage, my least favorite word in the retirement space, but a lot of time talking about these features to get folks invested and invested earlier and longer, and that's so important. But now we're gonna go a little backwards, and we're gonna sit through the lens of an investment conversation, and what differently can we be doing from an investment perspective to change the outcomes for participants. And we all sat through Dick Darian's presentation just now, old colleague and good friend of mine, and I thought a lot of what he said was super interesting. Consolidation is real, fee compression is real, and we're gonna talk a lot about these topics in this time that we have with you today. But he also talked a lot about asset managers, and I'd be remiss if I didn't say myself and my colleagues here today, we're all with BlackRock, and we're super committed to this space. We're super committed to partnering with investors, with participants, with sponsors, with record keepers, and with the entire retirement ecosystem. We're not going away. We just crossed $1 trillion in assets in retirement, and we're going to talk a little today about how we're thinking about this business going forward from an investment perspective. We're not a record keeper. We do not aspire to be a record keeper, but we very, very much aspire to partner with folks like yourselves, with sponsors, with participants, with consultants and advisors. I'm joined here today with two investors, two of the best and brightest at BlackRock. We have Chris DiPremio. Chris DiPremio is a senior investment strategist within our systematic active equity suite. This is a suite that BlackRock is 100% committed to, and Chris has worked a ton with sponsors and participants in the core building blocks of a menu. And we think that Chris and his organization has a really different lens that they're looking at investments, and a lens that folks should be looking at on a going forward basis. And we have Vinitha as well, directly to my right. Vinitha works within the retirement group. Vinitha is a senior investment strategist, and she works on our flagship products within the DC business. She works on LifePath and LifePath Dynamic, both our active and passive suite. So I've got a list of questions. I would consider them softballs for our panel here today. But this dialogue is meant to be a dialogue, so if you guys have questions, I'm not sure that we have microphones, but I know this room is rather large and awkward, but you can just stand up and I'll be able to recite your question to follow. So we'd love to get questions. You can interrupt us. You can ask us to go deeper. Again, we're here to have a conversation, not just to speak to you. So I'm going to start where I think probably 90% of these conversations at this conference will be starting, which is fees. A Callan study, a survey recently said 9 out of 10 plan sponsors are revisiting their fees on a 2-year basis. Gosh, that's changed. A decade ago, I'm certain that number was 2-3-fold. But plan sponsors are looking at fees on a 2-year basis now, and they're making a lot of decisions about their plan lineup based on fees. And my question for our panelists, I guess Chris, we'll start with you, is how can plan sponsors balance ensuring participants can invest in strategies that offer more than just beta, but can keep their fees reasonable?
So I guess that question is kind of multifaceted. I think there's been this myopic focus on fees over the past, call it decade. Certainly active managers have not covered themselves in glory. And when you look at kind of performance, and that performance is being mired by underperforming the benchmark on average based off that fee compression, I think the feedback loop in the marketplace has been investors and participants saying, rather than looking for a consistency of outperformance, just give me some sort of consistency of performance, and for that I'm willing to compensate you nothing, which has been just going to the ETF and the passive side of the landscape, this myopic focus on cost. By the way, BlackRock's been really successful at that. There's a small subsidiary that everybody here has probably heard of called iShares. So we've definitely been able to capture what that investor flow has been. I think there's a little bit of a disservice, though, to think about fees only through this race to bottom and not thinking about it through the lens of what the value add to a participant can be through time. From my team's perspective at Systematic Active Equity, and for everybody here from here on out, if you hear me say SAE, that does not represent Sigma Alpha Epsilon, just think of that as my portfolio management team. So within SAE, we view fee very much as a hurdle rate, right? And so, if you can control that hurdle rate, you don't have to take as much risk to overcome it, which leads to this consistency of performance through time. Doesn't mean you have to race to the bottom, but it does mean you want to put some sort of control mechanism in place that you can control that risk. And that's how you deliver consistency. I think for participants and for sponsors and plans in general to look solely through the lens of what is the lowest fee profile I can get to, in a world where beta markets are leading returns, that's all well and good. But in an era of returns getting back towards longer run historic averages, that's kind of doing a little bit of a disservice to participants who are going to need some incremental return profile through time. Doesn't mean you forget that you need to focus on fees, but what are you getting in return for the fee that you're paying? The other thing that I would mention, if you look at kind of all the Morningstar league tables and category returns, if you look at the top quartile performing managers, those managers also have the bottom quartile fees. So this interrelated concept of fees and risk and return, you're seeing it manifest across all of the top performers in the benchmark and within the categories. So you want to identify fees. From my team's perspective, and what I think everybody in this room should pay attention to is, if you need to get a little bit more bang for your buck, don't solely look at fees. Look at it with overall portfolio efficiency. And I know we're going to highlight some of those topics here in a bit.
And maybe just one thing I'll add is, generating return in general is a zero-sum game, so not everyone can make money. There's really no such thing as a bargain. So if you see something that is like off-market from a price perspective, the real question there is, what are you actually getting? And Chris's point is a good one, which is we really like to think about what's the value you're adding, because just looking at fees is really only one side of that. And again, there's no bargain of like good investment. Like no one is going to price at a completely different ballpark, and you're still going to get something great for it.
So the plea towards passive is something that's all over the headlines. And some of the statistics say that only 10%, however, of plan sponsor lineups are 100% passive. And at BlackRock, we believe that a good blend of active and passive does make sense. So Vinitha, maybe we'll start with you and say, if you're a plan sponsor looking at a plan lineup for your participants, where today do folks look at active as the best way to drive alpha?
Well, thanks, Tina. And I think maybe just Chris tied into this in the last response, but we're in a very interesting scenario here compared to the last 10 years. So in the last 10 years, if you just held really any asset, you did pretty well for your participants over that whole time frame. Didn't matter if it was active or index, you just got a great return. When we stand here now and we look forward, there are a few things that have shifted. So the first is the prospect is really for more moderate levels of return. And when you couple that with the fact that we still don't see the savings rates that we want, so participants really need more from their portfolio. And then you also have people spending more time in retirement, and fewer people have pensions on top of their DC balances. So when we look at all of those things, you've really got two choices as a participant. You can either, well, one, you can save more, and I think that will tie into later the importance of having a well-designed plan. You can take more risk, but the reality is, what are you actually going to get for that the additional risk you take right now? Or you can think about where and how you can add active returns into your plan mix. Now, what's hard here is, as I said earlier, all active is not the same and all active is not good. For every active manager that does well, there is an active manager that's underperforming. That's just the nature of how markets work, and generating return really is a zero-sum game for winners and losers. So I think the first thing we would think about, Tina, is where do you think you, as either advisor or a partner, where do you think you can identify and find good managers? Because the truth is that if you can't find something good, you always have the option to go index. And that's kind of what we think about, is what are those trade-offs of where can we find good managers, consistent managers, because when you have the daily flow potential for DC participants, that consistency of return is important. Otherwise, you'll tend to find that your participants will sell at the wrong time, buy at the wrong time, And then you also want to make sure that, again, you're getting a good net of fee return. And I think that's a great ballpark for where and how you can see what you're getting from your active managers. Within our active target date suite, the truth is we actually see a lot of opportunity right now, and we actually use a fair amount of the SAE strategies as being consistent outperformers over their benchmarks. But we're also just thinking about that, which is if you can find it, any additional net of fees return is good, but it really just comes down to what your option set is.
Okay, participants are underfunded, right? We know this. We know the average account balance is roughly $100,000. We know longevity risk is growing, and it's real, and it's rapidly evolving. According to a Vanguard study, the median account balance, not the average, the median is $56,000. So what can we as partners do to new or different to change the investment story for participants?
So I'll take that question on. I mean, from a personal perspective, my grandmother is 99 and a half. So that longevity risk is something that is keenly of focus within my family, and she is running out of, my grandfather's railroad pension. So the savings problem is something that's a huge challenge within this business, within this industry, and for participants. And we know how challenging it is every year to get a participant to increase that contribution rate by 1%. Why do we tell them to do it? Because we know that the compounding effects over a 20, 30-year savings cycle is enormous. I think that the flip side of that is with intelligent plan design, we can start to resolve some of that savings challenge with kind of the investment side of the ledger. It's all about incremental alpha, it's all about consistency of performance, about participant experience. That was a lot easier to achieve back when we started running money in 1985, right? We could do a very generic value screen, look for cheap versus expensive, and magically outperform the market. And if you were a fundamental manager, you could pick up the phone, talk to a COO, and you get the handshake, the nod, you know how to position your portfolio, and the run-of-the-mill active manager would outperform the market. It's fundamentally changed, right? I mean, two big things happened in the early 2000s. You may have heard of them. It's WorldCom and Enron, right? And so what happens now when you pick up the phone and call the COO? The COO picks up the other end of the line. They say, how's the wife and kids? And they go, hey, you should read the 8K. It's really good, right? So you've had this massive disclosure state, and the narrative in the marketplace over the past 10 years is that active management does not outperform the market, right? On average, it's underperforming the market. I don't think that's true. I agree with Vinitha. It's very much a zero-sum game. You have to be a little more thoughtful in your approach. And from our standpoint, it's all about the incremental delivery of alpha in a guardrailed approach. So I think what's unique about the SAE narrative and why we partner so well with Vinitha and team in the LifePath series is because we're providing style purity. We manage our risk and our characteristics to look and feel like the benchmark that you're hiring us for. So if a participant's looking at it and look at performance of what we're providing, the first words out of their mouth when they turn on CNBC is, oh wow, this thing's performing in line with the market. And it's saving them from that behavioral challenge that Vinitha pointed out, which is we know participants try to time not only asset classes, but then within an investment schedule, they're going to start to time who's outperforming or underperforming. And there's a big reason why that's a huge mistake. If you ever look at fund returns versus investor returns on Morningstar or Lipper data, there's the explanation. So you have a savings challenge, you have a timing challenge within participant discretion of their portfolios. It is not going to get them to where they need to be at the end of the day. And from our perspective, if we can be a little bit more intelligent on that investment side and solve that challenge with that alpha profile, help them solve that savings challenge and save them from themselves, then at the end of the day, you're going to have a much better chance of trying to hit that retirement goal through life. We do some very unique things with which to do that. We're going to highlight kind of the non-correlation of returns, which is extraordinarily jargony, but what I would say is today we're leveraging big data, machine learning, buzz topics in this industry. I saw an article last week of what I would call an antiquated asset management firm looking at natural language processing, which is great. It's really cool that they're looking at that in 2019. We've been doing it since 2008, so we've been very quiet in this space for well over a decade. And while all of our peers are looking at version 1.0 right now in an effort to tap into that market sentiment, we're on version 9. And to put proof in the statement behind what we're doing, the power of what we're doing, over the past 5 years in this marketplace where people have said active managers cannot beat the bench, 93% of my team's assets have actually outperformed their respective benchmarks. You are not talking about a random walk of performance in a strategy or two. Why is LifePath Dynamic using multiple SAE strategies? It is a platform level of consistency based on a low risk and a low cost platform, which quite frankly, if you look at the evolution of the market, participant expectations, and how that's all coming together, that intersection is along kind of the intelligent design of what we're doing.
Any questions from the audience? I got more. Okay, so you mentioned big data and machine learning, and I agree that those are buzzwords in the industry, but how can you apply big data and machine learning to actual investment portfolios to drive alpha for participants? And how do we simplify that story so that participants can understand it and then elect it in their plan lineup?
So the first thing that I would say is you apply it very cautiously. The most powerful thing in the world is data. And if you start with some data set, you say, I wonder what this thing is telling me, or what I can identify in this data, I guarantee you'll find something. Is it causal or is it spurious? And you don't really understand what that effect is until after the event happens and it reverses course. And so from our perspective, and I think the power with which we apply this at BlackRock and within SAE is you start with the fundamental thesis of what you're trying to solve for. You say, look, we've been managing money since 1985. We know what the predictors of stock price returns are. How can we identify that quicker in the marketplace? In the 90s, by the way, this is a pretty tremendous statement of the evolution of markets. In the large cap space in the 90s, the best signal that you could have had for a systematic manager was looking at sell-side guidance revisions in the large cap space. To put some clarity on this, if you were trading in any large blue chip company and the sell side community started to revise their guidance upward saying we think they're going to beat earnings, you had 6 months before you needed to trade on that investment with which it provided alpha. So upward revision guidance for McDonald's, 6 months later you trade on that information, you still got outperformance. Think about that today. Facebook, Netflix, Google, right? Any of the large blue chip companies, they have a guidance revision. What happens to their stock price and how quickly is that reflected? It's instant. So you learn something from a research cohort, you say, how can we get some early predictors of that? And you leverage technology with which to do it. One of the things that's been really effective for us in the retail space has been trying to identify same-store sales growth. And what we did is we looked at Peter Lynch and his theses of investing back in the 90s, which was we want to try to capture real-time foot traffic in the marketplace. How do we do that? We sent our most junior analysts to Macy's with a clicker on Black Friday and counted people walking in stores. That's great. You have a couple things. One, I hope you picked the right store because 34th Street Macy's operates differently than Birmingham, Alabama, right? And two is a time series of data. How often and what was your frequency of observation to actually capture a trend? The logic behind what they were trying to capture was real, but the application of information was just flawed. We feel we can resolve that with data analytics today. So the data that we have is actually looking at geolocation information from cell phones. We have no personal information. We don't want personal information. The only people that care where I am is my boss and maybe 50% of the time my wife, right? But what we actually do is we get this aggregated, anonymized information in 3 columns of an Excel file. The first column is number of cell phone pings, observations. Second column is a latitude coordinate, and the third column is a longitude coordinate. That data tells you nothing. There's no company, there's no ticker symbol, there's no transaction. But when you have 80 people globally and you hire people from the NSA, NASA, Google, and Facebook, and they build you a map of every known brick and mortar store location in the United States, all of a sudden everybody's iPhone and Samsung Galaxy turns into a clicker. We get this data every single day, and we get more than 60 billion data points a month with it. You no longer have a time series issue or a data issue. So in 2017, when we were overweight McDonald's, no pun intended, it was not the exuberance of all-day breakfast that drove the position. It was because across their 14,000 restaurants, we saw a 15% increase of foot traffic. When they came out that July and beat on earnings and said U.S. same-store sales growth was above trend, guess what? We captured that data as well. So we may be a systematic approach, but we're very much taking these fundamental views of companies. And when you do this and you can apply it across an entire market, That's the power of data, because when you do it across the breadth of the entire Russell 1 or Russell 2 or Russell 3000, guess what happens to your risk? It goes down. So you have that guardrailed approach, you're bringing in your tracking error, and you're delivering consistency of performance through time. And that's how we're leveraging big data machine learning, very much on the cautious side and very much tethered to economic rationale.
And one thing I just might add there in terms of how we would think about, why we'd want to hold that within a target date fund or really as a single plan line item is that point of like what's coming. When you think about one of the things that Chris touched on early on is there have been fundamental ways to pick stocks for a long time, and a lot of those haven't changed. The drivers of company returns are very much still the same. What's really changed is your ability to figure out what's going to change faster. And that's what we think about as being really just interesting in this evolution of active management is you can do what you've always done, but you may or may not be as successful as you once were. And we always look at what makes this manager differentiated, what makes it an unusual way of taking advantage of those same fundamental trends, but applying it to the future. And that's one of the things we like a lot about this is just how much it continues to innovate in terms of taking, again, very fundamental concepts of investment, but finding faster ways to come to those insights.
But the thing that's very interesting about that, right, is, and here's why it's worked, and here's why it's been powerful in this context of the markets. For the first time in history, you had a systematic approach that could actually take a qualitative view on a company. Right, systematic investing was always a back-tested, look for a premia, it's smart beta, it's not the same as dumb beta, it's smart beta, it's style factor tilting, and you just said, I think this risk will persist going forward. Well, all of a sudden now, these qualitative views, we're saying, let's scrap the premia and let's start having a forward-looking expectation of company-specific earnings. So when you look at the risk of our portfolios, what you'll notice is that there is this neutrality of exposure towards style. We don't have value or size or quality or volatility or momentum. By the way, if you have any active manager, I guarantee you half of their risk is some combination of those 5 things. You'll notice that we have no exposure there. And so the non-correlation of our return drivers to any other investment within a plan or within a modeled portfolio like a LifePath Dynamic, that improves, right? Laws of Markowitz persist. It improves the efficiency of your portfolio overall. And so these are all things about kind of intelligent plan design and trying to leverage some very unique capabilities with which to do it. The ultimate impetus behind this, and we're going to do a little bit of a fun academic dissertation here for 5 seconds. Does everybody here have Facebook? I'm looking for participation. Nobody? Does nobody in this room have? Thank you. Hands. Okay, perfect. What happens on Facebook when you like something on the news feed? More crap that Facebook thinks you're going to like starts populating. So for me right now, it's the Eagles. Go Birds. We beat the Bears yesterday. We're not going to talk about the Vikings or the Cowboys. So it has this predictive property of what you're going to like next. There was a study that was done by a firm that used to be in existence and made a big splash in 2016. It was called Cambridge Analytica. You may have heard of it. It had some very meaningful impact in the election, supposedly. What Cambridge Analytica found was that when you got to 300 likes in Facebook, the predictive properties of Facebook's algorithm on what you would like next were actually more accurate than the subject's spouse. So there's a couple things we need to, first off, that's a pretty harsh indictment on marriages in this country. But 2, this algorithm, which knows absolutely nothing about you, predicted with a greater degree of accuracy at what you would like next than the person who knew you the most at only 300 observations. Put that in the context of financial markets. Are we limited to 300 observations? Absolutely not. And that's the excitement around big data machine learning. When you apply that level of power on the qualitative side with billions of data points, you're doing this every single day in the marketplace, that's how you deliver outperformance today when the rest of the street is lagging. And this is part of the active management mechanism that needs to exist so that our participants can actually start to hit their longer term objectives.
faster, quicker evolution, right? These are all things that we constantly talk about. Millennials, they say that their average tenure at their employer today is about 3 years. So with all of this rapid change in the marketplace, the one thing about retirement planning that we know is it's not really fast, right? It's kind of a little bit of back to the future. And it's also the longest investment that a participant will have, potentially 40, 50, 60 years. So how can we, as investors, help the participant let time work for them?
So, I mean, the number one thing we can do there is think about how our plans are set up. So we always think about, we all talk about investments most of the time, but when you think about the value add of a really good investment in your plan lineup, the actual impact it can have is almost nothing compared to the impact of a better default rate and a better escalation rate. And thinking about how you let the plan work for you when you're young is critical in terms of actually getting people to save more. Now, a step below, we'd say you want to make sure you have great underlying investments and a great default investment, which is why target date funds have been so popular. They let people go into a single investment and then play to their own biases in terms of not having to touch or adjust anything unless they want to, and letting them have growth when they're young and more stability in retirement. It's really that package solution, Tina, of better kind of setups on the front end. Our colleague Dagmar is here, who can talk a lot about plan design as well, but setting up the plan well and then having a great qualified default investment alternative really gets you that package of across a lifetime. The second thing I would throw out there is starting to think about what that future looks like. So we've spent so much time with people working on that front end of how do we get people actually to enroll in their plans, to actually start saving, to save more as they make more. But how do we start to shift that conversation into helping people actually spend in retirement as well, recognizing that more and more people are going to be living solely off of their DC balances. So that's a big conversation that we're having with a lot of our clients now, and I think of particular importance on the record-keeping side as well is building that flexibility to let people stay in plan and essentially auto-retire, of being able to get those periodic distributions in retirement as well. The last thing that we really have been thinking a lot about on our side is what can we do that's really different or more innovative to help on that return problem with the QDIA. And we've been having more and more conversations about how do we think about integrating more active solutions into your QDIA to get people more return on top of those savings and those contribution rates. And that's really what we've been doing with LifePath Dynamic is thinking about with a really broad investment set and thinking about the basics of a target date fund of adjusting your risk over time. How do we start to add in that active return selectively, making sure that we're really delivering net of fee returns that are on top of what you're actually just getting by holding markets?
Yeah, I would just add on to that. I mean, it all comes down to risk and experience. I think we all focus on certain things within different lenses of this business, and we stick to those kind of characteristics and traits from a screening perspective. And we mentioned fees earlier, so sometimes people will look at, I just want the race to the bottom in fees. Sometimes it's just excess performance as well. So they look at what's the highest kind of excess return profile without understanding, what was the path to achieve that. And it wasn't hard 15, 20 years ago to find a manager that could beat the market by 6%. Today, you can still probably find one that has a year or two where they outperform by 6%, but my goodness, the risk with which to achieve that is going to mean pretty massive swings in that experience. If you're contributing, and everybody will say, well, we can dollar cost average into volatility, that's all well and good, assuming that you don't move out of that position and you hold it throughout that entire duration of time. I think that's a broader question of behavior, and I don't think it actually happens. And so, from the return and kind of the investment side of the spectrum, consistency matters more. Information ratios, right? The unit of active return per unit of active risk you're taking to achieve that return alongside a lower fee dynamic. You want to look at all of that kind of in concert when you're looking at how do we construct the most appropriate plan for participants. When people say active, passive solutions, and I've had some, these consultant meetings, well, we have passive and we're just going to, focus on cost, and it's, Vanguard and BlackRock over here on the passive. Then on the active side, it's like we have the highest risk things that we could identify, and we just let the participant choose what they want to do. And I see this happen all the time, and it's a massive mistake because participants are going to get their faces ripped off on the active side by trying to time different managers there, and then they're not going to have enough on the return side of the passive strategy to achieve their longer term expectations. So there is that middle ground, and I think you just have to try to find solutions that are a little bit more consistent with a higher IR. It's a different dialogue, a different metric of evaluation than probably most people think about in the investment landscape. But our institutional clients, and we manage retirement money, CalPERS, CalSTRS, ADIA, Saudi Arabia, Singapore, all these major monetary authorities, this is how they evaluate it for that very reason.
And it really fits into our broader checklist. So when we're thinking about what makes sense, you look at, one, your broad universe of what you have, and really beating your benchmark ends up being just table stakes to be part of the conversation. But then as Chris mentioned, we're looking 2-3 levels below at how consistently does that happen, recognizing that you've got the concerns around daily flows. Then 3, you're looking at, can I just buy this another way? Am I getting unintended exposures through my manager? Chris referenced this before, but a lot of people are just making money by, for example, in fixed income, by being overweight credit. In equities, they've made money by being overweight momentum, which has led them into higher tech stocks. And you don't want that. You don't want to pay for something you could just get cheaper, but you also don't want to pay for something that's just taking unintended exposures, because at a certain point, that will just circle back as that market reverses. And so you're really wondering, am I actually getting a manager who's doing it through security level selection? And then the last thing we always look at, and this is, I think, very relevant, a portfolio construct, and then we can talk about it in single manager world, but how do they all work together? We used to think about this, which is the joke that, what happens when you have 3 deep value managers? Things are great sometimes, and things are terrible sometimes. And your conversation when things are terrible ends up being about, I have 3 managers that are doing terribly all at the same time. You don't have to do that. We have lots of choices in this world. You can pair different managers together that are doing things differently, thinking about systematic approaches and more classic fundamental approaches. And when you think about putting all of those things together, you get the benefits of real diversification in a portfolio to help you get a more steady excess return over time. And then when I think about how that translates into standalone space, it really ends up being a lot of times a question of how you will work with your plan. And when I think about how much time sometimes people might spend on, finding the best manager in a single sleeve that has almost no assets, and then going either fully passive or not thinking at all about other sleeves that have really a wallet share of participant investment flows. It's really thinking about those trade-offs too, of the impact you're actually going to have to your end participant, and making sure that you have great options across the board, but are really thinking about where those dollars are going and how do you make sure those dollars are really getting the maximum risk-adjusted return that they can get.
The last salvo that I'll have on top of that, because she mentioned multiple managers in the space. A lot of times people will select different managers and say, what's the overlap analysis? Oh, they have different names, so it's diversify and put them together, et cetera. But they do that without understanding the factor exposure of what's driving their positions. So you may look at 2 managers and say, hey, these guys are diversifying each other, that's great, I'm putting them together, without realizing that they're both doubling down on the same drivers of those positions in and of itself. And guess what happens to the performance of those funds? They look highly correlated in both the positive and the negative performance. Are you actually improving portfolio efficiency? Or are you actually now having a very expensive exposure for something that you can get via a very generic smart beta ETF? So these are all things that we need to think about because of how democratized and commoditized different exposures and styles in this marketplace have become. And if you want to blame somebody for this, you can certainly blame BlackRock, because iShares has certainly democratized a lot of what historically had been active management with value, size, momentum, qual, and volatility, where you can buy these things for 12 basis points, and active managers are charging 1% or more to give you the same exposure. So it's just a different level of kind of identifying diversification than most in the industry are used to, but it's 100% necessary going forward.
Questions from the audience? I was just thinking while they were speaking a little bit about my role as a moderator, and I think I'm failing epically, because I think one thing I was supposed to do is definitely get engagement from the audience, and thus we haven't had one question. And the other thing is probably to keep time, and I have no idea what time it is and or when the session should be completed. So epically failing. 10 minutes left, guys. And I look out, I know some of you folks, and I know you're verbal, and I know you're curious. And I find it hard to believe in a room of folks that I know who are verbal and curious that there's not one question. I've got another one. I'm willing to go. I'm going to call names soon. All right, fine. Looking ahead. Okay.
So, you had mentioned millennials in retirement, and I know it's a big concern, especially their school loans are about the size of a mortgage on a monthly basis, and you also mentioned about the 6% that they're not receiving. So, how do we expect them to start saving, and what are they going to do in retirement when Social Security might not be available as well? They're not saving early because they don't have the money to save early. They're not paying bills. How, what would be the best way for them to go about it?
So a couple of things that we obviously talk through is the fact that a lot of people who are coming out of school now are facing different challenges than people faced 10 years ago, and really trying to think about, I mean, I know this is another buzzword like big data, but broader financial wellness, and recognizing that it's not just tied to retirement savings. It's really having an emergency savings bucket as well for things that could go wrong, thinking about how you start to pay down those student loans versus taking out credit card debt, and then thinking about when and how you can start to layer in your retirement savings. I think that's actually one of the ways, though, that thinking about plan defaults can still be very useful, which is it does force people to opt out and or change their retirement saving if they can't. But it also has people thinking about what that first paycheck looks like without even thinking about it. And so when I think about some people who are young, if you start at a reasonable contribution rate, they may not even realize for 6 months or a year, that maybe they want to change what their plan default rates look like for contributions because they want to be paying down loans in other ways. So defaults can actually help you realize what can I live with or live without in terms of actually starting to save. But I think that's the big piece that we've been really just talking about. And we talk about this as a firm holistically, not just retirement, but thinking about how do you help people feel better equipped and more financially secure. And that's not just retirement savings, it's emergency savings, thinking about the trade-offs and how and where you spend your money. But I would pair that also with your defaults in your plan, because you will find that for every person who's like, actually, I need to make a change, you're probably getting someone else to save a little bit more than they would have thought they could have saved otherwise.
I would add also folks like ourselves, as well as the record keepers, investing in the millennials. I think maybe since their account balances have been quite small, that we haven't really pivoted the conversation to them as much as we have and should have, and dedicated the resources to our conversations around instant gratification. I mean, I know every record keeper partner that we work with is working towards or already has in the market apps and whatnot to be able to work with millennials to get them to have that instant gratification, that Uber gamified-like experience, and investment partners like ourselves as well are thinking through, what is the best way to get a low-balanced millennial excited about adding that extra $5, $10, $15, $20, which selfishly speaking, maybe 5, 10 years ago, we just weren't looking at and investing in because we were focused on the high net worth and focused on the bigger balances, wrongfully so.
And to that point, Tina, I think even just reminding people that even the $5, $10 with the benefit of time can be so significant, because I think sometimes you've got people making trade-offs where they're like, well, if I can't put in enough, like why bother? But the truth is, even if you're putting in 1% when you're 22, with the benefit of time and compounding, that can be hugely valuable. And I think it's some of that conversation too of every little bit helps, and the truth is it's dollars and cents that will add up versus necessarily having to make wholesale changes to your life.
Okay, my last question. So we've talked about disruption in the marketplace. We all know the disruptors that have already taken place, the Amazon, the Netflix, the Ubers. There's a plethora of them. We've talked about big data and machine learning, but specifically to the investment landscape, to active managers who are driving alpha. Looking ahead, what do you think the disruptors will be?
So from our perspective, we think the low-hanging fruit of alternative data has already been captured. And the reason why we know that is because we were there first and we saw the alpha decay, right? So one of the things that we look at is how effective through time are the insights and the signals with which we're choosing our stocks. If that alpha starts to kind of diminish in length of time of your observation, you kind of realize, hey, as a research cohort, we need to go back to the drawing board and say, is something wrong with the process? Is there a new data set? How can we vet this thing differently? And kind of torture the information to contain and maintain that lead time in the marketplace. Once again, that's why you have 80 people. I mean, last year, we did 73 deep dive theses in research kind of signals for our portfolios. I did a thesis in college, took me 2 years. It was equal parts difficulty and procrastination, so to do 73 in 1 year is pretty remarkable. And that's the level of commitment and effort that it takes to sustain the advantage that you have in the marketplace. So a lot of it now is coming down to machine learned techniques. So I mentioned that we were kind of version 5, 6, 7 on some of our insights. I think one of the most fruitful places for us to be is on company executive conference calls. And the first version of what we went live with in the portfolios in 2010 was just a simple positive negative sentiment dictionary that we built within SAE. So every transcript would come out and we would build a ratio of positive and negative words. As that next quarterly call happens, did that ratio improve or decline relative to peers? There's your early indication of positive or negative sentiment. Sounds really generic, I would admit it is, but it worked quite well. And the reason why it worked was because you were applying a qualitative view across the breadth of the market. So we would not know as much of a particular name as a fundamental manager, but we actually knew a lot about all 1,000 stocks in the Russell 1000. Kind of that's the power of what the data provided. The way this thing has evolved is we started realizing there were a couple biases in our process. We defined what was good and bad, right? So we used to say that words that were complex were negatives, right? Because management teams are trying to confuse or obfuscate the truth from the investor community. That's great if you're Procter & Gamble, but not so great if you're Sage Therapeutics, which is a small cap biotech company, right? If you're a biotech company, complex terminology is probably how you describe your business. So machine learned capabilities absolve this, because rather than us at SAE saying these words are good or bad, we're saying scrap that. What words are every management team using that's more predictive of positive to negative sentiment through time? So we built a custom corpus or dictionary for every single company that we track on a 3-year look back. So every quarter the new call comes out, you're dropping off the earliest observation, you're picking up the newest. You have this constant evolving dictionary. So you have new management teams, new communication styles. It's picking up all of this through time. It's resolving all subjectivity in the marketplace. And rather than trying to clue into the sell-side community, which has been a pretty useless place over the past 2 years, the market inflection points, picking up on the nomenclature of every specific management team across markets has been extraordinarily powerful from a returns perspective. So from the future of investing, it's less about the data, it's more about that machine learned technique. And when people say that they're starting to explore this space, there's a very famous quant, I'm not going to besmirch a competitor, there's a very famous quant in Connecticut that has had horrible performance over the past couple of years. He hired 2 dudes from Facebook last year, and 2 months later he fired them. Why? Because it takes years to build the infrastructure with which to apply it for an investment thesis, right? So the moat around what we do is not the data. Anybody can acquire it. The moat around what we do is the infrastructure. The senior members of my team, their average tenure is 12 years. Think about a technology-driven investment capability. 12 years is pretty phenomenal to keep people there. Why are they there? It's not just a lot of restricted shares that mean that they can't leave BlackRock, so they have deferred compensation. It's because if they were to leave and start a hedge fund and charge 3 and 30, which they could do, the amount of capital to rebuild what we have in-house would be too much of a hurdle to overcome, and they couldn't actually achieve it. So people are still there because you have to be in it to win. There are only a few firms out there that can do it. BlackRock is certainly one of them, and the dollar share that we have at BlackRock to kind of build this out, you really can't find another peer in the mass market space. In the hedge fund space, sure, but in the mass market space, you cannot find a peer that's doing anything similar.
So on the QDIA side, Tina, I'm going to say something a little controversial, which is I think you're going to see more people actually applying things we already know work to target date funds. And And I know it sounds funny, but taking better advantage of diversification and thinking about how to add diversification both from an asset class perspective to a manager selection perspective through thinking about adding in tactical views. These are all things we know work. People use them in the institutional space on the wealth side, on the pension side, but they are rarely applied to target date funds. And we know they work. And so I would say that's really the next leg as I think about what's coming on our spaces is part one, how do I continue to add more diversification to my portfolio across a range of different lenses? And then two, I think is probably, and to be fair, some of that will also tie into what does it mean to think about alternatives within your target date fund and what should that look like? How should we think about that? And then part two is thinking about how do you really take people across that whole life cycle? So I mentioned this earlier, but it's not just about, it's very important to get people enrolled and saving, but you want to take them through that whole life cycle and help them also think about once you've gone through that phase, how do I think about starting to spend these balances as well?
Great.
But diversification.
Great, thank you. And we'll end where we started. Thank you so much for coming. Thank you for your partnership. At BlackRock, we are entrusted with the largest amount of passive assets, and that is something we take very, very seriously, but we also believe very, very strongly about the active part of our business and how important that is for participants and for plan sponsors when thinking about menus and helping participants close that gap and helping them retire with dignity. We'll be around for the rest of the conference. We look forward to continued dialogue and enjoy the day. Thank you.